Crazy time. Okay, so we are now streaming, and I will go ahead and share the screen again. And just give me one more quick yes in the chat if you can see the screen as of now. Should be working here. Okay, perfect. Perfect. Thank you, Andy, Mark, Dexter, Buck. Appreciate all you guys being active in the chat. And now we are live on YouTube. So things are working. Like I said, probably going to be a little bit quicker session today, but I'll always stick around if you guys have questions, if you want to dive into a couple stocks in particular. Elizabeth said, happy belated birthday. Thank you, Elizabeth. This was a very unique birthday because how I normally envision my birthday. I mean, I don't really care about my birthday a whole lot. I don't make big plans or anything, but I usually don't envision it waking up at 3 a.m. and, getting on a flight. It was a weird one, but it was good. We had some productive time down here and really looking forward to some of the stuff that we're working on. I am 34 for those of you wondering, turned 34 this week. All right, let's go ahead and roll on to sectors. Now, I've been talking about sectors ad nauseum for months as I talked about the volatility, because I think that one of the things that makes this market unique is how the sectors themselves are operating, both from a liquidity standpoint, how much are getting inflows and outflows, and also just from a pure behavioral standpoint as well. If you look at the bottom here, this is XLE. So DDC, how many children do I have? I have 7 kids, 6 daughters, and 1 little dude. So yeah, we're busy. So this green one here is energy. And what you can see with energy is a snapshot of how wild some of the swings that we're getting here are on a sector that would not typically be a, high volatility risk on sector. Now, that's one thing, okay? One thing is we're getting these big moves in sectors that would not, traditionally move as much. But I don't really think that matters, okay? For me, the idea that volatility is expanding and that we're getting more of it in sectors that don't typically move that much is not a big deal. It happens. If it does happen, it doesn't really affect strategies all that significantly. The options are going to be priced in for that for the most part. So for me, this doesn't really matter a whole lot that the sector is moving more. What I do think matters, and what I do think is important to understand about the market that we're in right now, is where the alignment is on which sectors move in which directions. So, for example, hopefully you guys can see my screen well enough that when I zoom in on some of this, or when I click on some of this, it'll make sense. Here's the beginning of the week. Okay, do you see this light blue line right here that peaked down? This is technology. And this is where energy is. Okay, so I'm going to ask you guys to be very involved in the chat to make sure that this point comes across. Okay, does everyone see how energy and technology collapsed together early in the week? Give me a yes if everyone sees that. Yes, technology and energy collapsed together in tandem. Energy collapsed almost 4%, technology over 3% in tandem. Okay. Then we kind of slowed down, but we're bearish. Then energy and technology rebounded together. Here's the green line, and then up kind of in the middle is technology. Again, this light blue. Okay, so let me ask again. Does everyone see how energy and technology rebounded together? Give me a yes in the chat if you see that. Technology and energy rebounded together. Okay? Yes, 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 yes. Perfect. Okay, then in the middle of the week, Wednesday going into Thursday, does everyone see how energy further collapsed while tech rebounded? Does everyone see this? Here's the blue line going up while energy makes its deepest correction yet. Give me a yes in the chat if you see that. Okay. It happens again here. Energy has a little extra percent correction while technology has its best 4-hour period of the entire week. The reason I'm taking so much time and getting so detailed here on this is because in the course of 1 week, we had major moves. We're not talking about the market wasn't collapsing together with massive liquidity yanks together perfectly in tandem, separating within the same week. Okay. So if energy and technology were just moving together now as the new normal, no big deal, right? We would just kind of say, okay, these are moving together now due to some external factors. As a matter of fact, James just mentioned, there are some external factors that make them align together. That would be fine. That would be one thing that we could very easily calibrate for. The challenge in this market is we went from perfectly aligned to completely opposite in the course of 48 hours. And we're not talking about 0.25% moves where, oh, it just, a company had earnings, so the dynamic changed, or we had a big liquidity flow, so the earnings changed. We're not talking about a 0.25%. We're talking about major moves representing hundreds of billions and even trillions of dollars in the course of 2 sectors going from completely aligned to completely inverse over 48 hours. And so for me, if you want to circle one reason why these markets have become really challenging, I would point to this. This is what I would point you to. We're not just seeing major volatility. We're not just seeing markets expand and contract more quickly. We're not just seeing liquidity flows change at a more rapid cycle. We're not just seeing earnings separate from expected responses to opposite responses at a high. Those things be normal in a volatile market. If you go back and look at COVID or these things, both bullish and bearish. None of those things are really going to break apart what you expect in the market. However, this thing where risk on and risk off or normal correlated assets don't stick together, but actually separate on an hour-by-hour basis and then rejoin is where I think we're seeing the most challenging market. And there's examples of this on gold. Gold has completely faded, meaning worked inversely from risk on some days of the week, and then correlated with risk on assets other days of the week. Bitcoin, being the most risk on, has correlated some days of the week and inversely responded other days of the week with risk off assets. And so this is where I think that we're getting the biggest challenge right now in the markets. Again, not because of volatility, but because of the actual relational dynamics of where, certain things should go just based on very logical outcomes. So what does that mean? Well, it means that you can't really assume, even if you know that we're going to be risk on or risk off, even if you believe the QQQ is going to drop deeper, it means you can't make obvious assumptions about how you should trade that. Here's an example. QQQ flipped this week. It flipped from a test and a bounce opportunity being bullish to now a test and a bounce being bearish. Okay. In other words, when we were above 510 or even anything above 500, I was cautiously bullish, where a test and a bounce, a test and continuation would be a bullish signal. Even though it's a shallow bullish signal, a test and a bounce would be bullish. Now we're in a situation where a test and a bounce to the downside would obviously be bearish. So we've kind of flipped, and now we're on the other side of the key level. Now, normally, this price action, a test here and a continuation, would be a fairly high conviction move. I mean, I would say if we test 500 and get a negative week, I'm now targeting 460, 450 with fairly high conviction. I'm not flipping everything to bearish, but I think there's a greater than 70% chance that we're headed lower. But in the current market, it's really hard to draw those lines. I mean, Roger was sharing earlier this week that divergence used to be one of the better indicators that we had, predictive models. where price and volume are misaligned. Now it means almost nothing, just in the span of a few short years. The testing ranges and the breakpoints have mattered less and less. But ignore that for a second. Let me give you a more practical example. Let's say we're right. Let's say we break, we test 500 in the last week of March. So fast forward 3 weeks, the last week of March, we have a nice bearish candle and the Qs are going down to 450. And let's say that we're actually correct on that prediction. Well, what you would usually say are, you'd usually say, what stocks then are going to be impacted? What stocks are we going to look to trade? Well, it's heavily tech, so we'll trade some tech stocks. Maybe we'll trade Apple, right? Apple doesn't align with this at all. If you're trading Apple based on a QQQ bearish sentiment, you're completely backwards on the last week. So a very practical example of this separation is that all of the normal logical conclusions that you would make about what stock should do what, just based on, kind of macro or even technical views within the indexes really don't align, right? And so for me, I think trading the indexes themselves, trading the sectors themselves, and then trading independent stocks that have nothing to do with those kind of general overarching market moves is probably the safest thing that we can do. And I use safest, the most consistent thing we could do, because you're still going to be wrong a lot in these crazy markets, but you're not going to be right and then be wrong. Okay, so let me pause for a second. What I mean here is if you say, hey, I think tech's bearish, I'm shorting Apple, and then tech collapses 5%, but Apple's 0%, now you are right and you are wrong. I think in a market we should try to strip out that extra variable and at least be right when we're right. So if we're saying technology is weakening, I think it's going down, just trade XLK. Magnificent Seven are getting a deep pullback, trade MAGS. Energy's strong, it's going to make a big rebound, which I think it could. Again, high risk. I don't think that's like a high probability, but I think it could make a snapback move. Trade XLE, don't trade Exxon. Does this make? I know I went very slow here to try to really draw out this point, because I think what happens in ugly markets is that people compound their mistakes. Basically what they do is they kind of make trading decisions that they think make sense, and they stack the scenarios where they can be wrong further in the opposite direction. So they do things like they say, man, technology is getting crushed. Let me go ahead and hedge my bets. I'll be long a consumer staple like Walmart. I'll be short a tech stock like NVIDIA. And this way, because I think that tech is going to continue to take a beating, consumer staple be stronger. Long Walmart, I'm going to be short NVIDIA. To me, that makes perfect sense. The logic I would agree with, and I think it makes perfect sense. The problem is, in a market like this, what you will often see is that they'll be right. Consumer staples stay strong, tech gets weaker, but Walmart returns to the mean and has a negative 4% week. NVIDIA bounces because of a deeper correction, liquidity jumps back in and has a plus 4% week. They right on the assessment, wrong on the trades. And I think that's the kind of extra variables that you want to take out of your trading right now. Trading is already going to be really hard in these volatile markets. I'm experiencing it firsthand. What I'm trying to do is pull out more variables that I can be wrong, which includes being right about, trends and opportunities and still being wrong on the actual trade itself. So hopefully that makes sense. Again, I took a little extra while there to draw out that point, just because I think it's really important when you get into these kind of convoluted, confusing markets that you just try to simplify the things that can make, turn more winners into losers. And that's what happens most often in these tough scenarios, that people, they kind of compound mistakes. And I wouldn't even say mistakes, just the market compounds the outcomes. And what you end up happening is you're wrong on all the stuff that you're already wrong about, right? So like you're wrong on thinking technology would bounce back the week before, whatever else, and you're losing money on that. And then you start losing money on even the things that you're right about because the individuals with the expectation of the market. Just like if you were short energy, long tech, or long energy, short tech on a trade on Monday, you would think, hey, I'm prepared for risk on, risk off environment. And instead, they sunk together over 4%. And then you would say, oh, wow, technology and energy are running together. Let me, instead of energy and technology flip, they go in opposite directions, and utility starts going with technology, and you get kicked in the face again. And so some of the ways that I think that you can simplify and avoid that is to trade those assets directly. So instead of saying, hey, energy and tech are separate, or here's this type of pair trade energy on its own direction, trade utilities on its own direction. Don't grab Exxon, don't grab Apple, don't grab Walmart outside of kind of mechanical strategies that make, that align and make sense. So that's kind of the first big takeaway that I think is happening. The second big takeaway is basically that the breakthrough points here mean very little to me right now. Again, I think if we get a retest and a move lower on the QQQ, that is a good sign of bearish continuation. But I think it means less right now in this market than it's ever meant before, because the way the market's moving, these kind of test and drop points have had very little validity going forward. And a good example of this is how bearish the QQQ looks, which it does look very bearish. A retest and a continuation of the QQQ right now would look very, very bearish. At the same time, the S&P looks like it could actually find support here, and a continuation on the S&P jumping to 580. On the QQQ, it's going to look like a retest of this area and look bearish. On the SPY, it's going to look like a test and a break back to the channel to the bullish side. So the same move next week is going to look bearish on this chart and bullish on this chart, which is a good example of kind of how disjointed the market is and where some of those levels really are tough to make sense of. So what I would do in these situations is try to, less use those levels as kind of predictive analysis of where you expect the market to go, and just kind of trade the sectors in shorter term bursts, and then focus on the mechanical strategies like we've been talking about for weeks and weeks and weeks now. Speaking of those snapbacks, that's where I think we have an interesting trade, and again, another high risk trade here, which would be XLE. This is on the weekly chart. I think it is a high risk trade, but basically what we have here is we have a channel. Pretty much every time we've got an oversized move, like you see that kind of hits the bottom point, like here, 2 weeks here. This one was about 4 weeks of negativity, kind of into this oversold area. Here, just one big week, again, peaking out at over 6.5. We've seen at move, and so that's the play here. Obviously, if energy continues to get weaker, it can easily break down through here, and so this is a very high risk binary trade, just like almost all the trades that I've been taking, but this is one that we could take. And if energy does snap back, which it already did snap back quite a bit, by the way, already snapped back almost 3%. So we kind of missed the opportunity. That would have been great on Wednesday. But still, I think, given how much upside room we created with the downside move, it's an interesting little binary stab that you could take and target about 100%. So this is the trade that you could take here. It's a debit spread. Whoops, I put that number in there, 89. Oh, sorry. This is me trying to work on the laptop again. There you go. There you go. This is the trade that you could take, which would be a debit spread. So this would be targeting 89 bucks, about a 2% move on a continued jump to the upside on XLE. Obviously, high risk, like I said. If next week we just retest here, we're going to be dead in the water. If we break down, we're going to be dead in the water. What we're looking for is a continued snapback. Basically, we're looking at this and saying, hey, when the market peaks really, really low on some of these areas, in 1 week, we've seen it kind of put up 1 to 2% gains the next week. So that's essentially what we're looking for, is to see if we get some, kind of rally bounce back on XLE. And then we put a target in here so that we don't need to actually get it to finish higher at the end of the week. We just need kind of a pop of 1 to 2% in the first half of the week, try to get out with a winning trade. And then, even if it does fade back or anything in between, we still have the potential for a winning trade. So I'll post this one in the chat if you guys want to consider it. Again, emphasis on high risk. I'm taking some of these stabs with very little size, just trying to grab some extra opportunity as the market bounces back and forth. And so XLE is one that I like, simply because it was the most extreme this week. That's really the only reason for XLE. It's not because I think the inflows and energy are great. It's not because I think people are migrating to dividend stocks. It's not because I think the risk-off environment is going to hold up and XLE will go up in a risk-off environment. Clearly, this week proved that it will not. It's none of those things. It's simply because it was the most overextended this week. And as we look for some of these snapback opportunities, I think it makes the most sense to trade. So that is our weekend trade. All right. Anyone have any questions, anything in particular that you'd like to look at before we wrap up? Oh, sorry. XLE here is the green one, Mel. So it's the most overextended here at the peak. It hit the most extreme here, which again would have been great to buy it on Wednesday because we already did recover about 3%. But what I'm basically making the trade on here is on some of these previous big corrections, we ended up putting up 2 to 3% positive, and so if with like 2% more follow through, then we should hit our target on XLE if we get that pop. Should be about 40 cents. I mean, I didn't look at it in the last just couple minutes, but should be about 40 cents there, and an 80-cent target or a limit credit. Target's 100% gain without actually needing to predict where the market is going to finish. By the way, the two-way trades, I mean, I think are certainly an obvious way to trade right now. I'll talk about those on Monday. So if you guys are not doing the two-way trades, I mean, that's clearly the layup right now in this chaos is to use the two-way trading style. The whole reason I kind of invented that way of trading is because I was so stacked on the bullish side, which I still am significantly stacked, but I was so stacked on the bullish side that I at least wanted to have some insurance when we got these big aggressive market pullbacks. So thankfully, I did the two-way trades. It's been great to have those. Expire on Monday. Have a new trade here in about 30 minutes on that one. And I'll talk to you about that on Monday. I'll do a little bit of a case study on the two-way trades that we've done. I would do a session on covered calls. Sure, Lauren, I can do that. I did a little bit of an update on the covered calls a couple weeks ago, so you can check that out if you'd like. It doesn't go deep, Lauren, but it kind of goes into the general kind of key points that I look for, and I'll try to do a deeper session at some point as well on that, because that's been the one thing that has done nicely here. Not enough to like wipe away losses, obviously, but for me, having some balance in the portfolio that just creates cash while I'm in drawdown is obviously a nice bonus. As far as covered calls, there's a couple bullet points that I use here that I shared a couple weeks ago. But basically, what I'm looking at is I'm looking at doing it on the most volatile stocks that I hold. So stocks like coin, stocks that like IBIT, tickers like that. They're going to be highly volatile, and then I'm setting myself up in a position where I don't mind if I get called out. And there's a little bit more to thinking through it than that. But that's essentially the simple rules that we want. We want to get enough cash up front that it's worth doing it, which is why you need the high IV. And then you want it to be called out at a price that you're happy to lose it and just take take the profits at that price. And as long as you are fulfilling those two things, then you're probably going to be pretty happy with the covered call. Now, how do you do that, and what is a good IV and which dates you should use and all that? We can talk through on a more detailed call, certainly. But again, generally, those are essentially the two things that you want to balance: cash up front, and am I happy if I get called out of the stock? Yeah, so with the XLE trade, I put this limit here as soon as I get filled on the trade. That way, anytime next week, if we get a pop, I'll get taken out with an automatic exit, which is what I'm always going for on those kind of trades. Yep. Okay. Any other questions? I'll leave that slide up here for just another minute so that you guys can see. You guys can see that trade if you want to take a look at it, or you want to paper trade it, or whatever you want to do. But I think the real question for us is not necessarily are we gonna get into a bear market here, or are we gonna snap back into a bull market? I actually don't think that's really the question right now. I think the question is, are we gonna get out of the full chaos mode? Are we gonna start pricing in some more of the kind of tariffs and switches on that? It was interesting to see that gold seemed to price that in a little bit more this week in particular. So if you look at gold here, whoa, can't get my screens to work. There you go. If you look at gold here, it's kind of interesting that gold had these really big gaps, these really big corrections, and then it kind of acted risk off, and then it gapped up and all of that. But then this week, so you take this week, and basically gold's going to end up basically break even. Had some good moves. Like this was obviously a big sell-off on the day where we started. What did we start? Up 0.5% and finished down 2%. I don't even remember at this point, how extreme each move is. But the gold's going to kind of end up break even this week. So it seems like gold's maybe getting used to it. It's still more fluctuation than you typically expect from gold, obviously, but seems like, at some point we're going to start kind of pricing this in more readily. And so to me, I think that's the bigger question. The question is less, are we going to get into a bear market or a bull market? I don't know. But I think it's more so, are we going to get some consistency either way? Are we going to get some kind of normal in-range movements? I mean, keep in mind, the SPY doesn't really move outside of 1%, 90%, like 97% of days or whatever the number is. Very, very low number. And we're doing it like 50% of the time, in the last month. So these are very abnormal conditions. I think they're the new normal to some extent, but I still think we're at the extreme end of the new normal. Like I said, it's funny for me because this is exactly what I predicted. I should be patting myself on the shoulder saying, yeah, you called it. You said volatility is what to expect. That's what to prepare to trade. You called it before the big 3% moves happened. Great job, Nate. You did it. And instead, I'm sitting here saying, yeah, I called it, but I didn't call it exactly like this. The form it's taken is still a little bit bizarre and hard to kind of quantify and prepare for. So I think we need that to settle down to at least kind of get within a range of new normal that we can trade, and kind of things will pan out within an expected reasonable range. It doesn't, the market's never going to be like, hey, yeah, technology's up. So technology's up 1%. And every tech stock is up 1 to 1.5%. Like, you're never going to get that, but you want it to kind of collapse into an expected range. And I think until we get that, it's just going to be a lot of the same stuff that I've been saying. Use the covered calls, use the pair trades, stick to the mechanical strategies, really try to be disciplined. All that kind of stuff is just going to be me, beating that dead horse over and over and over again. And then once we kind of get within a reasonable range where, sectors flow more consistently. Again, they're not going to be perfect, but more consistently. Risk off and risk on assets separate more consistently. Not going to be perfect, but more consistently. Once we get those kind of things to tone down, then I think we can get back into high gear, whether that's a bear market or a bull market. I mean, literally either one. That's not what I'm talking about direction. I'm talking about in terms of actual, market function. So yeah, that's in large part what I'm waiting for. And I'm sure I will continue to give you the same boring advice over and over again in the meantime, but I hope it's helpful. I hope just being here, in and of itself is kind of a good reminder, pulls you back into the center and gives you something and want to dive through specific stuff like some of the ones that I got today, a session on covered calls, maybe a session on particular pair trades that you can look at. We can obviously do all of those kind of things and take them one at a time. Let me post the XLE trade in there for you one more time in the chat. Not sure. I pulled this about an hour ago, so I don't know if XLE has been moving much in the last hour. Looks like it's moved up. Yeah, it's moved. It actually has moved up about 50 cents. So probably going to be a little bit more expensive than the 40 cents where it was at right around 1 o'clock. So you're probably going to be looking at a little bit higher price on XLE, I'm guessing. Mike says it's about 45 cents now. Thank you, Mike. Audrey, to set a target, it depends on your broker what exactly the terminology will be, but as soon as you get filled, so Audrey, order with a limit, and then you're setting it up as a good till canceled limit order. Usually, if you just YouTube your broker how to set up a GTC limit, just literally YouTube that, you should find some really good examples. Mike asked, could you use the 88.5 to 89.5 strike instead? Because you'll probably bring you right back down into the 40 cent range. Mike, you can. One of the things that you have to keep an eye on there is sometimes the 50 cent spreads don't have quite as good a liquidity. So fills can sometimes be a little bit tougher, specifically on the closing end of it. So I try to use the whole numbers as often as I can, but we're not talking about, a ton of volume here where thousands of people are taking the same trade. So you're probably fine. All right, folks. Well, thanks for jumping on. As always, I appreciate your time. I know you could be anywhere else today, and you chose to spend some time with me, which I do not take for granted. I really appreciate every single one of you who spends some time with me, ask good questions. I hope that the stuff that I share is valuable, even when it is, kind of the boring, mundane, diving into the nitty gritty of why the sector separation matters. I hope that's valuable for you. If it's not, I'm always happy to take criticism. That's part of what I want to do here is to provide the absolute maximum value to you every single time that I do this. Because for me, there's no sense in me being here and doing this and spending my time unless it's valuable to you. So that's my goal. If I can ever get better at that, let me know. Always happy to do that. Dexter, yes, it will come in about 10 minutes. Cool. Thank you, everyone. Hope you have a great rest of your week. And Timothy, I just saw your question there pop up. If you mean specifically on the trade, like I said, honestly, YouTube is one of the best things that you can do. So how to trade a debit spread on my broker is always kind of one of the easiest things that you could do, or literally call your broker and say, hey, I'm trying to put in a debit spread. Can you help me? And then just work through it a couple of times. Those are some of the easiest ways, I think, to help you kind of get used to trading or. All right. Thank you, Sandra. Thank you, Dexter. Thank you, Mel. Thank you, Joy, John, Andy, Dan. Thank you all. Hope you have a great weekend, Ed. I appreciate you. Hopefully next week is a step in the right direction. More consistency, more even liquidity across some of the sectors. All that. Thank you, thank you, thank you. Hope you have a wonderful weekend. And I will see you all. Elizabeth, thank you. I will see you all next week.